from the morning reading, and if you hear me make reference to I, it's the author and not myself. Key lines in the sand. There are certainly some concerns in the stock market right now, but I have yet to get a bearish signal to confirm these concerns. The bond market imploded over the last few weeks. Long-term treasury yields surged. Small caps have been lagging since early April, and breadth has weakened. Nevertheless, the S&P is still within 2% of a 52-week high and is still in an uptrend. I am not worried about the surge in treasury yields because the rise in yields is a positive sign for the economy. Yields would not be surging if the economy were weakening. I am not that concerned with relative weakness in small caps because the Russell 2000 accounts for less than 10% of the total U.S. stock market. When it comes to bullish or bearish call for the broad market, I'm going to use a relatively simple breadth metric to measure buying and selling pressure. High-low percent. High-low percent equals new 52-week highs less new 52-week lows divided by total issues. Buying pressure has an edge when high-low percent is positive. Selling pressure has an edge when high-low percent is negative. In order to get a broad market view, I'm going to analyze the high-low percent for the S&P 500, S&P Mid-Cap 400, S&P Small-Cap 600, and NASDAQ 100. I would turn bearish on the market when high-low percent for 3 of these 4 indices moves below minus 5%, which would suggest a material increase in selling pressure. Note that 3 of the 4 moved above 5% on October the 22nd, and this signal has yet to be negated. 2 of the 4 dipped below minus 5% in mid-December, but a third never confirmed, and all 4 were back above 5% the very next week. In the short-term battle zone for the SPY, the spider is within a wild range since April the 17th. I'm calling this a wild range because there have been 5 swings greater than 2% in the last 5 weeks. High to lower to low to high. Trading is treacherous in this range, but the overall trend is still up. Spider hit new highs in February and April and remains well above its first support zone. Even though the ETF is having trouble staying above 211, selling pressure is still contained, and we have yet to see a significant support break. The uptrend, therefore, remains in force. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:13 a.m. Central Time, and I'm recording this in preparation for the market day, May the 13th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into the overnight action. As you heard from the reading, there's been a lot of concern about where is the market going in recent action, and we've talked a lot on this morning video about these ranging actions. But I have to agree with the author that when it's all said and done, while we recognize elevated risk levels in the market, at the same time, the default is a bias to the long-term bullish side until proven otherwise. Now, in our own overnight action, as we get down to the microcosm of today and what we expect with today's open, we have slightly bullish conditions across all 4 of the broad market indices, and all 4 of them are up around 0.25% as of the time of this cut. Crude oil is up almost 1%. The euro is scratch. Bonds are up about 0.5%, and gold is up about 0.25% as well. In overseas action, China down about 0.58%, as is Hong Kong. Japan up about 0.75%, and we have Germany up about 0.75%, and United Kingdom up about 0.5%. In terms of macroeconomic reports for today, Wednesday is a very, very crowded schedule. And yet there's not awful lot going on. There is in the pre-market retail sales. That certainly could be a mover. It says an awful lot about the short-term economic activity. And then you have crude oil inventories, as is typical of Wednesday. There is, and this is put as yellow flag here, but given the action in the bond market of late, there could be more concern about this 10-year bond auction than perhaps its yellow flag invokes. So be aware of that right at midday today. And that should take care of the macroeconomic reports for today. In terms of our current volatility trends, very interesting price action yesterday. We ended up with big time rejections across all four broad market indices of the morning lows, and in most cases got back above the highs, or certainly near the highs or the open of the day. So that in itself should be something of a bullish sign. Big long tails in the bottom, and we've had that a couple times in recent trading sessions, would seem to indicate that there is some institutional support at the bottom of this range that continues to persist. Short-term VIX is at a 13.82, nothing there to get terribly excited about. The skew, note that it's 123.92. You get up about 125 to 135, that certainly can get your attention, but it's not there yet. IV percentiles 21, 18, 29, and 34, all in the lower thirds. Nothing really of note there. We did have a standard deviation move put in by the S&P 500 yesterday, though the other four indices were within a standard deviation move. So look at the S&P though. 1, 2, 3, 4, 5. 5 of the last 10 trading sessions have been standard deviation moves or greater. So while we see these low IV percentiles and the low VIX, and the obviously the VIX has stayed within that 12 to 18 window for quite some time now, we still see pretty significant price volatility during the course of the day, even if it doesn't generate any kind of specific fear by the put buyers in the market. So it's certainly been a trading range and continues to be so. In terms of the daily report, we still have those elevated risk levels. And remember, when we talk about hedge level 2 and so forth, that is an indication of elevated risk, not a probability that we are going to break down. That's a separate issue. Now, the probabilities that we could break down are certainly elevated, and that's why we watch the different technicals that we do to get these opinions and be able to be prepared for that possibility. But certainly the overall bias is that we do expect, while we've had the recent, and we are in phase 5, the breaking of support levels, we've broken both horizontal and diagonal support of the most recent, as opposed to the most recent being a new high. That would help us have an opinion of phase 3. The overall long-term bias is still long-term bullish until proven otherwise, much as the author iterated at the beginning of our video. But certainly we do have these elevated risk levels. IBD status, this is a big one. Market in correction, that should tell you an awful lot. GMI index has flipped back over to a buy signal as of the 11th, and is now a 4 out of 6. And if not to be confused enough, you have your market posture as a first day bullish. And indeed, when you look across all four indices, they're quite a bit more beneficial to the bulls than they have been in recent days. We've had a lot of mixed signals here, with indexes pointing different directions. And certainly as a first day bullish and having the flip-flop back and forth, we're not going to make too much of this, but at least they're all in alignment now. S&P is bullish, Dow is bullish, NASDAQ a weak bull, but nearly above the 50 line, where we would call it all-out bull. And then Russell, a very weak bull. So while not terribly impressive in the strength of their bullish signals, at least they're all calling for bullish signals. You have still with hedge warning status threshold level 2, and at that level we suggest significant caution with the initiation of new bullish trades, both short-term and intermediate term. And in addition to that market and correction, you have this very high distribution day count. Certainly it's been very difficult to see follow-through in many swing trade setups or on the initiation of core positions and seeing anything in terms of reward for taking that risk in the market with your capital at the present time. You also have the VIX daily squeeze still present. High-low, nothing really to get excited about here. We have that warning from the S&P crash warning on our E-mini charts of late. The intermarket risk aversion indicator, still no change there. It's still just the one signaling a risk-off condition. In terms of individual opinions, option income strategies, no change here. VIX is and continues to be inside the acceptable windows for option income strategies, but we have the significant potential for increasing volatility and recognition of that market and correction situation. Covered call, cautiously bullish, mostly aimed towards the management of existing covered calls and calling for a 1-to-1 distribution between in the money and out of the money strikes. Put selling, market and correction condition makes the suspect for selling of puts. I know I have substantially reduced my exposure with put selling, but when you do put on puts, when you find that you have something of interest, look for bottoming patterns and then consider put credit spreads to define the risk more sharply and consider scaling into positions. No real change on any of those three opinions in the last session here. You have on our sector market posture, pretty much looks like a Christmas tree. Very, very mixed signals coming from here. Perhaps the thing we should point to the most is, where we have some consistency across the time frames, financials and industrials up across all three time frames, utilities down across all three time frames. But even there, we're going to put a caveat on that. Many of these lines are quite flat given the ranging activity, and they can flip from 3 up to 3 down in literally one trading session. Sector percent change, you see energy had probably the best day yesterday, but probably the bigger case to make here is just how down these were at certain points of the morning and the recovery that came into place. We had hammer-like patterns put in on most of the broad market indices, and certainly if we looked at sector specific, we would probably see much of the same. So there was quite a bit of recovery here, but still ultimately negative with many of the indicators. And from our shadow trader friends, their trend scores for individual industry groups, retail, internet, healthcare, railroads, and biotech remain top 5. Well, that should take care of us for today. As always, greatly appreciate your investment into us by showing on YouTube that you like us, and then of course sharing with your trader friends and community about what you think is of value with what we are providing here each morning. More information about other things that we do at the website that's indicated here. Performance matters, we get that, and we're very transparent. 2-week free trials are available in the Portfolio and Options membership. Disclaimers as always, hit the pause button if you need more time to review this, and we'll look forward to seeing you back here tomorrow morning before the market opens with our market preview from Falcon Global. Thank you.